Welcome everyone for an impromptu on-the-fly interview with Josh Dunlop. Josh is, he's also in Denver where I am, and he's a certified financial planner. And I asked Josh to just hop on real quick to help our members understand a little bit about investing, what's going on in the stock market. We are recording on April 8th, 2025. So this is kind of a timely thing, although I think some of this stuff we're going to talk about is evergreen in nature. But there's sort of a reason why we're doing it right now after some pretty historic days in the stock market that just happened with the tariffs. So Josh, I will let you take it away.
Absolutely. And so the first thing I just want to do is talk about where the market is right now. And I want to do that by looking at the S&P 500 ETF SPY. Now, the S&P 500 is the 500 largest companies in the United States. It is one of the most widely recognized and widely used indexes in the world to track United States securities. And there's something very particular that I want to show you, and that's that it's difficult to know the whole story sometimes when it comes to what's happening in the market. So, as we can see here today, April 8th,
this is just one day, everyone. I actually didn't catch that. I thought it was over the year, but yeah, this is just one day. Okay.
This is just one day, and this is a really important thing because every single chart that you're ever going to see is going to look either really good or really bad. And you really need to check over here at these, 530, 520, 510, 500. And you can see here that this is far different than this.
Very different stories, yeah.
Very different story.
Quick question, Josh.
Please.
First off, Josh just Googled SPY, right?
Correct.
And then I actually, could you explain what is 560, what is 480? Like, what is that a measure of?
Yeah, that is a measure of the price of this security right now.
Okay.
So you can see right now that it is $496.48.
So if you were to buy one unit or one share of this index, that's the price of it right now.
That is absolutely correct.
All right.
Yeah.
And this tracks the price of that thing over whatever time frame you plug in here.
Absolutely correct.
Yeah.
And you can see here that at the beginning of this 1 month period, a month ago, we were sitting at about $560. Mm-hmm. Now, again, this also looks pretty bad, but I would actually like to zoom out to a year, because a lot of times when we zoom out enough, we begin to get a little bit of a different picture. Mm-hmm. Now, we can see here that over the end of last year, there was actually quite a bit of exuberance that began in beginning of August. Mm-hmm. There was quite a bit of positive feeling about the elections, mm-hmm. Mm-hmm. and a lot of run up to the inauguration, mm-hmm. which you can see right about here.
Yep.
Now, this is really important because the stock market is not a measure of the value of companies. It is a measure of the speculated value of companies.
So meaning in the future.
Exactly.
Yeah.
So that's really important because I might think, if I'm right here January 17th and I'm feeling very positively about the new administration, right? Again, just hypothetically, I'm going to be willing to spend more on one unit of SPY than I would normally be willing to, because I think SPY is going to be worth more a year from now than I think it is going to be worth today. So what we're seeing here, and this is something that you just don't hear enough people talk about. What you're seeing here is the market changing its opinion. It's not reacting to actual damage just yet in the market. Mm-hmm. And so what you're seeing is a lot of speculation over the last year kind of peter out.
Right, and actually we're at the level that we were at 1 year ago, just about.
Exactly.
Yeah.
And so you can see here that exuberance
Oh, we just switched to 5 year.
Yeah, we just switched to a 5-year chart.
Okay.
And you can see the run up really beginning in 2023, a year before the election even started.
Mm-hmm.
And so, again, a lot of this wasn't because the market was doing better. A lot of this wasn't, I mean, everybody was here during the election. There was a lot of talk about, questions of if the economy was really validly going up, if the economy was really good. There were a lot of those questions. And yet, despite that, during that time, the market was going up a lot based off of people speculating that the market would get better if Donald Trump won.
Mm-hmm.
That has not worked out. And so what we're seeing is a return back to those pre-exuberance levels.
Mm-hmm.
And so I think that's just a really important thing to help people understand is that, what we're losing right now is definitely a lot of value,
Yeah.
right? But a lot of that was value that we gained flippantly, if I'm explaining that well.
So kind of like it overinflated in a way.
Exactly.
And this is a kind of a correction. Like if you were to go back to that 5 year, like there's actually a different line that it's now snapped back to.
Exactly. Yep.
Yeah.
Yep.
Okay, so all that to say is like first off, zoom out. Like yes,
Yep.
this was a rapid precipitous fall. That it doesn't normally happen. That happened last week. However, when you can zoom out, first off, there's just bumps. There are. This was a big one, but we're not at zero. We're actually back to where we were this time a year ago. And of course, hey, if someone like first invested, 6 months ago, yes, on paper, they will have lost value. And it all depends on what they want that investment to be for them. Right. So now I want to just talk about individuals who are like saving for retirement. Is it really depends on like just what kind of time frame they've got. And I think I'm so glad you showed like you got to look at what kind of time frame, how long are you going to have in this? And one thing, and correct me if I'm wrong, but when people tell me, oh, I just lost so much money in my retirement account, I say, no, you lost value.
Correct. That's a very good way to look at it.
Yeah, you bought 100 shares of something. Those 100 shares are each a little smaller, but you still have 100 shares. So, and that's the thing with investment, it can like grow and contract, but you still have the same number of units. Let's just, in this hypothetical where you're not buying and selling anything. So you may lose value, you don't necessarily lose money. Because that all depends on when you sell.
That is correct. And, there's two other things that I want to show you here. I want to show you first off, because, the stock market, the S&P 500, that's just one of the many different types of asset classes out there. And what I'd like to show you now is I'd like to go back to a one-day look, and I'd like to show you the bond market.
Okay.
Now, the
So
bond
that's just
market,
BND, if you want.
BND, yes. And this is just a Vanguard Total Bond Market Index ETF. Again, both of these are just ways to look at a market.
Mm-hmm.
But if we look here, down again a little bit, but as we zoom out, we can see that it's down far less than stocks and up for the year.
Mm-hmm.
Bonds tend to move in a different way than stock does. They tend to lose a lot less over time and gain a lot less over time. They're just less volatile. If you think about stock as the hare constantly running the race really fast, bonds are the tortoise. Slow and steady, more predictable gains.
Right. You get gains, right, or you can anticipate gains. They might not be as magnificent, but then you don't have the risk of losing value as much.
That is absolutely correct. Now, there's always risk, available there.
Yeah. Yeah. I
But
mean, yeah,
at
you
the
can
end,
tell it's still bumping around there. Like it has changed. Yeah.
but unlike with a year period where we were looking at, basically 500 to 600 here on this far left-hand side, here we're only looking at 70 to 76.
Oh, so it's
And
really
so
a smaller
you can
range.
see just how much smaller it is. And this is why it's so important to always check the relative data. Because when you start checking the relative data, you begin building a context. And context building is something that the stock market media is not very good at.
No.
If we lose 10% last week, it's the only 10% there ever was, and it was the scariest thing that ever happened. But
Yeah.
as we begin to zoom out, we begin to see that the market, as on a whole, there are places in the market that are gaining. We can even see it with gold. Over the last year, up 27%. The money that's leaving the stock market is going elsewhere. It's not just going to cash. It's not just leaving and evaporating. The people are taking the proceeds from the stock market and investing it in things like gold and bonds. Now, I'm not saying that you need to go out and invest in gold and bonds, but what I am saying is that diversification means being in more than just the S&P 500.
Right. I want to pause there because I feel like, okay, even if you don't think you're very money savvy, you probably heard of it, diversification. And this is the perfect example. And my analogy is like diversification it's like a bouquet of flowers, or it's actually a well-planned garden is a better analogy, right? You've got your flashy annuals that look great, that have the most potential, right? And that's more of your stocks. And then you've got like your bushes and your succulents that take a long time to grow, but man, they're always there in your garden. And so actually the best garden has a balance of each of those. And it takes some time to get established. And then in this analogy, the market is the weather. And like
Right.
that's what you can't anticipate if you're going to have a rainy season or a drought. But you kind of build a garden where, hey, in the drought seasons, your cactuses are going to do better. In the rainy seasons, your annuals might do better. But you have some of everything, or at least a balance of many things. And that is where having a planner can help you with that, right? And that is very
Absolutely.
dependent on your age, on your earnings, and all of that.
Yeah, finding that diversification, because right now it's not even the S&P 500 that's necessarily getting hammered really hard. It's actually 7 stocks known as the Magnificent Seven. Stocks like Apple, Tesla, Nvidia. These are companies that people went kind of, for lack of a better term, whole hog in. They were just
Yeah.
very excited. There was, we talked about the exuberance in the S&P 500. Well, the exuberance in stocks like Tesla was even stronger.
Yeah. Right. We're
And
seeing
so,
some specific ones that might have gotten a bit bloated
exactly,
because, like you said, it's all about the exuberance, the speculative nature of it. Oh, this is going to be big.
exactly. Now, this
Yeah.
is the classic tale, right? You see something like the S&P 500 or like Tesla go up tremendously, potentially double in a 2-year period of time. And that is the exuberance trap. You're going to feel FOMO. You're going to feel that fear of missing out. I don't want to miss out on, all of these gains. So you're going to enter, and I'm going to go back to the SPY chart here. You don't want to miss out on all of these gains here, right?
Right.
Or all of these gains over here. So as you're watching these gains, it's just tempting you more and more and more as this continues to go up.
Right.
What you're seeing is that everybody's making money, but what an advisor is seeing is that the risk is actually creeping up here too.
Right.
Because this has begun, because it's going up so much here and going up so much here, it's outstripping a lot of its own value. It's going up faster than the company itself is actually able to generate value.
I mean, kind of like there's a loose, I'm kind of thinking about real estate in a way, right? All of this
That's
pricing is so
exactly,
subjective.
you are, there we go. You are reading my mind.
Okay.
Residential multi-sector real estate, most people don't realize that this moves the same way that stock does.
Interesting.
The difference is that I can't log on to your home's value every day and watch how much people are going to be willing to pay for it on a minute by minute basis,
Well,
right?
Redfin does try to tell us that, but yeah.
Well, Res, this is actually just kind of the whole market, right?
Yeah.
So
Yeah.
it's giving you an idea of what your house value might potentially be based off of where you are, how it might potentially be changing. But just like real estate, it fluctuates. The stock market and real estate are both going to fluctuate in major ways. And the people who, how about this? Vanguard did a study a number of years ago, and they were looking for what things in common do the best investors have. And what they found was that the people who did the best the longest, the number one thing that that investor did was forget their password.
Yeah, don't touch it.
Not touch it, not get freaked out by it, not think about it, not look at it. Now, that's incredibly important for people, I think, who are retiring, who have 10, 20, 30 years to retirement. But there are people that are watching this that might be 5 years from retirement. They might be in retirement.
Yeah. So, okay, I do want to talk about that because these are different brackets. And we had kind of thought of like, okay, let's think of, there's sort of three brackets of people here, really just age bounded. So we've got like our youngest folks. We've got our, let's say 20 to 40, right? You're working, you're maybe growing a family, you are, putting into retirement, but you're probably 20 plus years until needing to use those funds. So how should someone who's between 20 and 40 years old just sort of look at what's happening with the stock market right now? And their little baby retirement funds that are like, just went down and for the first time.
And it's scary. If you're 20 to 40, if you're in that age bracket, the stock market's not the best investment you're making right now. Doesn't mean don't be in the stock market, right? It just means continue to invest on that retirement front. But the investments that you're making right now that are going to make the biggest impact are the investments that you're making in yourself, the investments that you're making in your family, the investments you're making in your primary residence. These are the foundations that you're going to build that are going to take care of you more in your 60s and 70s than the stock market.
Okay, that's really interesting. And I don't think a lot of planners would say that, right? You investing in your health, you investing in your communities, your mental health, your own family is going to actually that's an important financial vehicle.
Yeah. Where are we going to be as America in the year 2050? I have no idea. You have no idea. No one has any idea. And that's really the big question for if you're 35 right now, in 25 years, where's the market going to be? That's the number one biggest question. And if no one can answer that, then there's no reason to expect it to do anything different than slowly go up over time, which is what it's done for the last 100 years.
Okay, gotcha. So let's say someone's 35, has maybe 10 or 20 grand in their company's 401k. So it's, probably more invested because they were younger. So they probably saw that that drop off in the last week. I can guess what you'd say, but what would you say to that person who's like, oh no, I just lost all that money, quote unquote?
Two paradigm setters here. The first paradigm setter is if it's going into your 401k, it is 25 years or 15 years if you're 35 before you can even begin to use it, right? There's going to be penalties on you if you begin to use it. So, with this money, just continue to save that little bit that you're saving into your 401k, because the biggest benefit of saving into your 401k also isn't the stock market, as you would think. The biggest reason you're investing in your 401k is because your employer is probably matching it. And that is immediately doubling your money.
That's the free.
So when you're looking at that $20,000 that's maybe sank down to $15,000, and it's very, very, very frightening. Remember, half of that money isn't even yours, right? It is now, right? But half of that was money that your employer put in for you. And so had you been saving on your own, you would have only had half to begin with. So you're still ahead of the game.
That's a good point. Yeah.
Because the investments that you're making that are doing really well are the 5% that you're putting into your 401k that is getting matched 100% right away. That's a really good investment. Those are the places where you are making the biggest strides.
Okay.
Where the market is on a minute by minute basis or on a week by week basis, that's all just noise.
Yeah.
And that is really important to people who are going to send out quarterly statements and then get a lot of angry phone calls about it, right? But the people who have, more than a quarter, those are the people that yeah, just focus on what you can control now. And what you can control now is your savings rate. What you can control now is benefits like getting a complete match on your 401k. Those are the kinds of things you can control, and those are where you're going to make the most money right now.
Right. And if you're in that situation and it's being taken out of your paycheck, keep it going, even in this turbulent time. Yeah.
Absolutely.
Okay.
There's something called dollar cost averaging. And dollar cost averaging is the idea that you just put the same amount of money into the market, no matter what the market is doing, on a set period of time. And that's kind of how 401ks were set up to be. They found that a lot of studies have found that dollar cost averaging actually subtracts out a certain amount of the risk from the market. Now, you're still going to get, a lot of ups and downs. It's still the market, it's still investing. But because you're investing little bits at a time into the market over the long term, it actually smooths out a lot of your averages.
Yeah.
So if you were to stop investing into your 401k right now, you would actually be missing out on some of those smoothing actions by being able to buy low. The market, is going to not continue to go down. It might, right?
We just
But
don't know. Yeah.
right, if you're continuing to put little bits of money in as it's going down, again, that's what you're controlling. You're taking that money, you're combining it with your employer's money, and then you're putting it into something that is going to grow slowly over time, even if it's going down right now.
And I would say, even if you're in a place where you don't have that kind of employer thing, or you're self-employed, that dripping into your own IRA or whatever is still like very much something you can do. Everyone can have their own IRA and to still drip into it.
Absolutely. Now, some people between 20 and 40 might have shorter term goals.
Sure.
If
Right. Really, what we
you,
were talking about was all retirement, like capital R
right,
retirement. Yeah.
yes, if you're saving for a house, then you don't want to be in the stock market. You want to be in something that is a little bit more conservative, a little bit more, you want to be in something a little bit closer to the bond market. Now, I'm not giving advice to anybody in this particular instance, but what I am saying is that there's a greater level of diversification that is needed if you are closer to being able to use those funds. And so what I really want to get across here is, if you have a significant amount of money saved up and it's going to go to a home and it's gone down significantly, there's probably a little bit of an unwinding or an exit strategy that needs to be done. And that can be a little bit tricky. I would open yourself up to maybe talking to an advisor just initially, having them look and look over your investments and just tell you kind of where you're at.
Right. And this might be true also for someone who's 65.
Right,
Who,
right.
right. Yes.
Because for somebody who's 65, right, the short-term goal is their retirement.
Yeah.
So the shorter the goal, the shorter the time horizon, the more diversified you're going to want to be, because the less likely it is that any one of the major asset classes is going to do well, over that 5-year period of time.
Could you just quickly identify the major asset classes? I mean, we talked stocks and bonds. What else is there?
Stocks, bonds, hard assets like real estate, commodities, oil, things like that. Stocks and bonds break down pretty significantly into their own categories as well. With bonds, you have your classic, what they call safe or less risky bonds. Those are going to be like your treasuries, your municipal bonds, bonds that are
Like
issued
government
by
backed.
government-backed bonds, or business bonds that are backed by very large, very well-established businesses. Those are, you think of a CD, right? A CD is going to be very low risk because it is guaranteed by an institution that has FDIC backing, right? But you also have more dangerous types of bonds out there. And I don't want to miss on that, because
It's not like all bonds are low risk.
right, all bonds are not created equal. There are some bonds out there that are issued by organizations that don't have very good creditworthiness. In the same way that people can have really good credit or really bad credit, businesses can have really good credit or really bad credit. And so when a business's credit is bad, it's going to offer you a greater interest rate to invest into their bonds. And that's another very similar trap.
Oh, so it could be
where
tempting. I'm going to get this great
it's,
interest rate, but
yeah,
there's in itself is actually risky. Yeah.
absolutely, absolutely.
So, okay, now I want to talk about like an older group, like 40 to 60, which is where I land, where it's like, oh, I'm actually getting closer to retirement. I don't know if I can consider myself so young. But we still have quite a bit in stocks in our retirement.
Mhm.
How do we sit with this downturn?
In a lot of ways, the advice is the same, and I just want to reiterate some of that advice that's the same. I love your garden analogy. I think that it's especially a good analogy because at the end of the day, you eat things out of a garden or you pick things out of a garden, right? And so if you think about the stock market and you think about retirement, like those old farmers, hundreds of years ago, who had to live and die off of their crops, right? That's where diversification of crops originally began.
Yeah.
I have no idea if I'm going to be able to eat one crop, but I know I'm going to be able to eat one of three crops,
Hmm.
right? And so it's really important for somebody who is nearing that 60 mark, who is nearing their own retirement, be that at 60, 70, 50, wherever. If they're nearing their retirement, it's really important for them to diversify out as well. And
So
you can
even if
diversify.
okay, so even if we've got this like cliff edge of a lot of stocks, the S&P 500 going down, and they're holding, a mix of things, would they? It seems like it's very emotional in terms of like, oh, should I get out of that position if it's going to keep
Right.
going down? It probably depends on like, well, if that's just part of your retirement, could that be a little more patient? Maybe there are other things that you could shore up to be a little more stable right now.
Absolutely. Absolutely. There's something that is known as the bucket strategy.
Okay, what's
And
that?
it's basically where you have three big buckets. Your first bucket is going to be all cash, your second bucket is going to be all bonds, and your third bucket is going to be all stock.
Hmm.
Now the idea is that you're going to have enough money in your first and second buckets to be able to live comfortably for 3 to 10 years.
Okay, so I want to say so between cash and bonds,
Mhm.
aim for those two things together to be enough for you to live on for 3 to 10 years, which leaves the stocks to be able to do their bumpy ride and hopefully
Correct.
capture the gains. And then,
Correct.
okay,
You
it's
know,
3 to 10 years. Yeah,
Yeah, I want to point out that these are rules of thumb too. You know,
totally. Yes,
I don't want people thinking that because there may be some people out there that are, in their late 40s, early 50s who don't even have 3 years saved up,
completely.
right?
Yeah.
And so what do you do in that situation? Well, you continue to grow little bits of cash and little bits of bonds to slowly become that, 3 year, that 3 to 10 year.
Yeah, I mean, I feel like we experienced this 5 years ago with the pandemic. It really emphasized when we talk about 6 months of emergency fund, we all went through
Mhm.
that like, oh, that's not just a theory. Like, and I feel like that kind of brings this up again. I mean, emergency fund is still like super important, but to
Absolutely.
have more reliable cash on hand, that's the ideal, so that you can have, my friend calls it patient money. You have
Yep.
impatient money, impatient money, and to save, try to maximize your income and be managing your cash flow so that you have more patient money with enough current money, impatient money to use right now.
Yeah.
So someone who is so hopefully, if someone's at that 60-year age or older, using that bucket strategy, right? So if even though they're seeing the stocks go down, hopefully they've got some cash and bonds that are not going down, and that's what they'll use right now.
Correct.
Forget their password on the stocks as long as they could, right? And
As long as,
and
yeah.
and let that balance out, and not necessarily sell it all.
Right.
Yeah.
Right. And I think that now is a really good time to, if you don't have a strategy yet, if you don't have if you haven't sat down and thought about what your retirement's going to be, if you haven't sat down and really thought out what your career is going to look like in those final years, now's a great time to do that.
Mm-hmm.
Because controlling what you can control means controlling kind of the three levers, right?
Mm-hmm.
You can work longer when it comes to retirement. You can spend less when it comes to retirement. or you can invest more before you retire. Those are the three things that you can control. And after having done hundreds upon hundreds of retirement plans, I can tell you, focusing on those three things: when am I going to retire? How much am I going to spend in retirement? And how much am I investing now? Those three questions are going to be 10 times more important than where is the market right now.
Right, in the last week or whatever. Okay.
Right. Right.
This is very
Because,
soothing, Josh. This is very soothing. Everyone just kind of,
yeah,
if you want to get on the internet and look at that, look at a 5 year and
look at a five.
take some deep breaths. Yeah.
And here's the other thing, and this is really this is not the first time we've been here.
No.
This is the first time that we've seen a president act this way. This is the first time that we've seen tariffs of this level, but this is not the first time that it's felt like the world is ending in a way that's going to have long-term consequences. I was watching a webinar from April 2020 the other day, and somebody made a joke on that webinar. They said, well, in May, et cetera, and somebody made the joke, well, that's if, the world's going to be there in May. And no one laughed.
We were
Like, there was
really
one or two
there.
chuckles, but we were really there. We were really afraid that the world wasn't going to exist come
Yeah.
summer.
I was
Um,
setting up my old job before I went to grad school. I was doing operations for a small business. We were literally setting up our company's 401k plan like the week Lehman crashed.
it's such a it was so frightening back in 2008
Yeah.
because we had never seen housing prices go down that far.
That it was the
Suddenly,
sure thing, but if
yeah,
I'm sure there's graphs. It was ballooning. It was over
yeah,
speculative, right? And so it was a hard course correction. But if you had everything in real estate, that's also why you got to diversify and not have everything in real estate.
yeah. And even before that, 9/11
Yeah.
was another period where the market went down for 3 years almost
That was the
after
year
9/11.
I graduated and was trying to get a job.
Yeah, it's scary. It,
Yeah.
it it felt like nothing was ever going to be the same again, and nothing really was ever the same again.
No. Yeah.
But what I want to point out was that the world felt like it was ending in each of those three separate occasions, and it feels like it's ending now. And I heard somebody say, well, it's worse because it's self-inflicted now. Well, okay, well, maybe. But if it's self-inflicted, doesn't that give us more control and power over the problem? And so it's really scary right now, and I want to say that part of that is by design. I think that part of it is because it's supposed to be scary.
Chaos.
But if you fall back on the things that you're in control of, again, your biggest investment is probably never going to be your 401k. It is probably always going to be yourself and your family. It is probably always going to be the things that your house that you raised your family in. Like, those are the things that are going to be your biggest investments over time. And so continuing to focus on those things and continuing to focus on what's important and letting the stock market do what it's going to do, that is really where you need to be, because I've seen it again and again and again. I got into the industry a little after 2008, and there was a whole grip of people that were just sitting in cash. They had lost 30-40% of their portfolio because they were too aggressively invested. They panicked, they sold out, and the problem was their faith in the market never returned.
Yeah. It's the
I remember,
uncertainty. That's recessions are actually about uncertainty, right?
yeah.
Yeah. Right. Where you
And
just
so it's,
keep at it, and time is your best asset. And if you are at a place where you need to use that money, hit up someone like Josh, make a little bucket plan, because it doesn't mean you need all of that money at 62 either, right? And to start having the bucket, start having kind of like a drip plan a little bit.
yeah.
I keep bringing up gardening, right? have,
Yeah,
have your
no,
drip system.
I'm going to steal that because I think
Okay.
that the garden is a really I might expand it to crop, kind of like
Yeah,
a
yeah,
crop
yeah.
rotation, but I
Totally.
love that because it goes back to food and consumption
Yeah.
and things that we actually use as human
And the
beings. So
tending and the long game and having an
yeah,
established garden and yeah, and then I think, and there's some you can control what seeds you buy and how many. You cannot control if it's going to be a drought year.
right,
So you
right.
just keep at it. Well, this has been, I think, really helpful. I hope it has been calming for some of our listeners. A little bit about where to go, a little bit of recognizing when just present day emotions are feeling chaotic, and that's sort of by design. Depending what age bracket you're on, that's going to shift some of how you see this. But for most folks, sitting back, letting this go, forgetting your password might be one of the better things. And if you're in a place of like, ooh, I don't know if I'm diversified enough, talk to an advisor. This is not something
Absolutely.
you have to know on your own. If you're not interested in it, you don't have to be. You can find someone to help you.
Somebody intelligent once said to me that every day I go home to a house that I had no clue how to build.
Yeah.
You don't have to be an expert in everything.
No.
Everybody's an expert in what they're the expert in. So,
Yeah. 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 And maybe now more than ever, maybe finding an advisor who's aligned with you. And that has come up recently. And that can be hard to find out. But Josh is a good one, guys. So I'll put his info below on the video. Thank you so much, Josh.
thank you.